Hi, my name is Paul Kopesky. This is Finance 451. We're going to talk about investment analysis today over 10 companies. We picked two industries. I picked the U.S. coal industry and the U.S. shoe industry. These are all U.S. companies. For the coal industry, the first company is Alpha Natural Resource. For the second, we picked Arch Coal. Third, Cloud Peak Energy. Fourth, Consol Energy. And 5, Peabody Energy. For my second industry, I picked the U.S. shoe industry, and I picked Crocs, Nike, Skechers USA, Under Armour, and Vans. One of the biggest numbers we're going to use today is ROE, so I broke it down so that we can understand it. ROE means return on equity. So as you can see, I have return on equity at the top, and I broke it down into ROA, and it says leverage multiplier, but this is also referred to as the equity multiplier. So you take your ROA times your equity multiplier equals ROE. You can break down the ROA even further though into profit margin and asset turnover. And then again multiply all the way across and you'll still get ROE. Then you can break down the profit margin even further into tax burden, interest burden, operating margin. And again you can multiply that by asset turnover, and the leverage multiplier all the way across would give you the ROE. We're going to go in more depth about these as we get to the companies, but the basic gist of it is the higher the ROE, the better the company. So for the coal industry is first, this is the ROE over 5 years from 2009 to 2013, and the average in the last column. We got Alpha, Arch, Cloud, Consol, and Peabody. The first two are Alpha and Arch, and as you can see they have a negative average over 5 years, so that's not very good compared to the other three who all have positive. Even though Peabody had two negative ROEs in the past 2 years, in 2012 and 2013, they're still average overall. So we're going to get into Alpha and kind of see why they're negative. As you can see, their tax burden is pretty good. It's around 90, it's at 171, 94, 95, 81, 83, and it's averaging about 105, which is actually really good because how you figure out the taxes is you take 100 minus the tax burden and it figures out how much taxes they're paying. So they're actually getting a little bit of money back. But their interest burden is really bad. It's around 28, 58, negative 418. And then you got 21,000, and then you got 170. I don't know about this 21,000. It might be an outlier, but somehow they end up with a positive interest burden, even though they're doing terrible these first 3 years. But we'll move on to operating margin. You want this operating margin to be around 10 to 12, and theirs is at 4, 4, 2, negative 0.2, and then negative 15. So that's where they're doing really bad. So we'll just move on. We'll move on to Arch, another negative company. They're doing a little better in their tax burden, but they're doing terrible in their interest burden. They're at a negative 553 average, which just means they're just spending way too much money on their interest. They can't afford it. Their operating margin was doing pretty good up until these past 2 years. So once again, you see why they're negative. It seems like the leverage ratio is around 3 for this industry. It's been pretty constant in the past 2. But we'll move on to our more positive companies. Here we go, Cloud Peak. They have an average ROE of 25, which is pretty good. It's pretty high. They have a tax burden around 84, so they're paying about 20% taxes, which isn't too bad. They have an interest burden around 86, which again, around 15 in taxes, which is where you want to be. These are better numbers in the past 2. And here you go. You have the operating margin, which is around 14. That's where you want to be. It's a perfect situation for Cloud. Their asset turnover is okay. It's not too bad because on the asset turnover, you want the assets, which is the bottom of the equation. It's basically sales over assets. You want one asset to equal at least one sale, and they're pretty close at 0.7, but it's not quite where you want. You'd rather be 1 to 1 or a little higher than 1. But their leverage ratio, which shows how much debt they can afford, is doing pretty good as well. It's around 3, which is pretty average for this industry, you can see. That ratio is founded by you take your assets over your equity. So one equity equals 3 assets, so that's pretty good. They can afford a lot of debt. Console's about, they're doing pretty good. They're doing a little worse. They started out, but they have this really bad outlier here at 1,433, which makes their average jump a lot. But as you can see, they were increasing in their tax burden, which means they're getting better with their taxes. Their interest is pretty average all the way through. Actually, it's a little higher, so it's actually really good. It's pretty consistent. 173, 76, 100. Leaves them at 98, which is pretty good. Operating margin is good. It's at 11. It's where you want to be. Asset turnover is a little low compared to cloud, but their leverage ratio is a little bit higher than 3, so actually they can take on a little bit more debt than the past company. Our final is Peabody. This is the company that had 2 negative years most recently. They're increasing in their tax burden, which is good. You want to see that. They're around 70. They have 280 here, which gives them around a 100 average. So it shows that the average is a little off. The interest is pretty consistent up until these past 2 years really hurt them. That's why they have a negative there. And their interest burden, their operating margin's really good. It's at 15. That's where you want to be. This is above industry average. Their asset turnover is 0.5. It's a little low. Their leverage ratio, they can take on, it's around 3, like I said. So they can take on pretty much average amount of debt for their industry. So what did we learn? We learned that Cloud, Console, and Peabody are our top 3 because they all have a positive ROE over the last 5 years. This is the ROE trend. So you can kind of see on a graph how it all started. You can see that Cloud was the highest, and that Console was the more consistent, and that Peabody dropped off in those last 2 years. Cloud had a big dip in 2010, but they got it back on track and they still lead in the industry. This ROA trend, which is how we broke down the ROE. It's basically the exact same trend, so this kind of shows you ROA and ROE kind of go hand in hand. So next thing, we're going to go to our price to earnings ratio, and this shows that the price per share over the earnings per share. We want this to be pretty high. So you can see that Cloud has an average of 11, and Console has been dramatically gaining over the past year. After 2011, 73 to 1,000. That 1,000, once again, I just don't know how competitive that number is. I don't know if it's an outlier or not, but you can see Peabody was doing pretty consistent around the 20s, and then they started dropping off, and they obviously went negative in this past 2 years. That's why they only have 3 results. So again, we can look at this on a graph. I did include Console's last 1,000 because it would have made the graph really expanded, so I wanted to keep them pretty close. You can see Peabody also doesn't have its last 2 years. So you can see that Cloud is doing the most consistent. They're pretty safe if you could go by PE ratio. Next, we're going to go to our market to book ratio. You can see this calculated by you put your market value per share over your book value per share. This is basically showing you value of the company and showing you how their value is pertaining or being persistent, I guess you could say. You want this to be pretty high. As you can see, Console is actually leading this ratio. You got Cloud, or no, you have Peabody in second and Cloud in last. You see this on a graph as well. Like I said, Console at the top, Cloud in the bottom. Cloud and Peabody kind of have the same trend, while Console is a more gradual. Just move on. We want to know if these companies can afford their interest, so use this time interest earned ratio, where you put your earnings before interest and taxes over your interest. You want this to be high because it shows how much interest you can borrow and pay off. So you can see that Cloud can actually afford their interest the most. They're doubling Console and almost tripling Peabody. So this shows that Cloud's a little stronger company when it comes to borrowing and being able to pay their interest. Now we're going to look at the weighted average cost of capital. You want this percent to be very low because it's basically showing you the value that you missed out on or could have added to your company. So you want that to be kind of low. So we got cloud here at 6.6. We're just going to compare all three. And you can see that their economic value added is a negative 1.20. So that's actually pretty low as you're going to see compared to the industry. You have Console, who's at 8.3, so they're a little higher than the 6.6. And their economic value added is a negative 816, so they're a lot lower than the negative 1 point. This is Peabody. They're also at 8.3. And you can see that their economic value added is a negative 74.33, so they're doing a little better than Console, but still weaker than Cloud. So overall, we can see that Cloud Peak Energy is the best coal company in the industry. They have the highest ROE, the most constant PE ratio, the lowest weighted average cost of capital, and the lowest economic value added. And they also have the highest time interest earned ratio. We're going to move on to our next industry, which is the shoe brand industry. We have Crocs, Nike, Skechers, Under Armour, and Vans. As you can see, the averages are all positive, so this is a little bit safer industry than coal. And the highest would be Nike. Coming in second would be Under Armour, and then we have Vans. We're going to just talk about the top three. So as you can see, the tax burden for Nike is very consistent. It's around 75 completely across the board. Their interest is also pretty consistent in the last 4 years. It was 80 here, but they're pretty consistent around 96. So they're doing fairly good. They're around 75 and 96, so they can obviously do a lot of interest. They can borrow. Taxes are not paying too heavily. Operating margin's really good. It's at 13 average, so they're doing really good. This is where they kind of take a leap forward over that coal industry comparison, is that their asset turnover is a lot better. Their assets generate a lot more sales. They actually generate a little bit more than 1, so they're at 1.4. And their leverage ratio, they can, obviously, if it's Nike, they can afford a little debt. I'm going to go to Under Armour. They're a little worse in their taxes. They're paying a lot of taxes. You can see they're around 60, so 40% taxes. Their interest burden isn't too bad. It's pretty consistent all the way across at 97 as well, just like Nike. Their operating margin's at 10, which is a little lower than Nike. Their asset turnover, again, 1.7, so they're generating a lot more sales off of their assets, so they're a little bit more efficient than Nike. And their leverage, like I said, they can borrow a little bit. We have Vans here, who, on average, their tax burden is pretty low as well. They're still around that 60, so they're taking about 40. Their interest burden is a little better. Operating is a little lower at 8. Their asset turnover at 1.2, so they're generating a little bit less sales than both companies. And their leverage is still around the industry average, which is about 2. Here's an ROE trend of all 5 companies since they all were positive. You can see, obviously, the 3 consistent companies are the ones I just went over, which are Nike, Under Armour, and Vans. So we learned that our top 3 companies are Nike, Under Armour, and Vans. Even though all companies have been positive ROE, only 3 were consistent. Price to earning ratio, like I said, we want this to be high. Under Armour's at 41, while Nike's at 19, and Vans are at 17 on average. So Under Armour's kicking butt here. You can see on the trend, on the graph, the PE ratio, once again, Under Armour in the lead. We have market to book ratio. You want this to be high as well. Under Armour's in the lead. On average, they're at 5.9. Nike's at 4.0, and Vans are at 1.8. Here you go. You can see it on a trend as well. Market to book. This is the value. We want to know if they can afford their interest, and this is where it gets a little, I guess, hard to figure because Nike has consistent numbers across around 90. Under Armour only has 1 year where they have numbers. So you could say that Nike's doing a lot better, even though Under Armour only has 1 year. So I'll give this edge to Nike. We're going to talk about, again, that weighted average cost of capital, Nike's at 8.6, and their economic value added is 1,312.37, and this is in millions of US dollars. As for Under Armour, they're at 10.2, so they're a little higher. So Nike has the edge there, but their economic value added is 41.51. So that's it's a little better. I mean, a little worse than Nike. So you can see why Nike's a little better when it comes to weighted average cost of capital. But overall, the best company would have to be Under Armour. They have the second highest ROE to Nike. They have the highest PE ratio, highest market to book ratio, the second lowest weighted average cost, only behind Nike, and the lowest economic value added. And they have the least amount of debt. I don't know if I showed that. So we'll go back. Nike's taking on 2% debt, while Under Armour has 1.6% debt. So they're a little less debt. I don't know if you want to consider that good or bad, but they're generally the same, but it's the least amount in the industry. So now we're going to compare both industries. We have Cloud Peak, which is the gray, and we have Under Armour in the blue. So ROE, Cloud Peak beats Under Armour. They're at 25.18, and Under Armour's at 16.04. So Cloud Peak wins that one. But for the PE ratio, you see that Cloud Peak is getting dramatically beat. They're at 11.3, while Under Armour's at 41.3. So you can see they're 1-to-1. Market to book ratio. You can see that Cloud Peak is at 1.6, while Under Armour's at 5.98. So Under Armour again wins that one. Weighted average cost, you want this to be the lowest number. You can see that Cloud Peak is a little bit lower. They're at 6.6, while Under Armour's at 10.2. So they're doing a lot better there. So now it's 2-to-2. Economic value added. You have a negative economic value added for Cloud Peak. You want this number to be generally positive. So I'm gonna, even though that they were the best in their industry, still Under Armour beats them at 41.5. So it's 3-to-2, and then you have time interest earned. This is about if you can afford your interest, and you see that Under Armour is beating Cloud Peak at 42.3 over 12.5. So as you can see, these industries aren't really that comparable, but if you're going to compare them, you see that Under Armour wins, even though the ROE for Cloud Peak Energy is a lot better. But the rest of the ratios put aside, you see that they're doing a lot better, Under Armour overall. So I would have to say that the best company out of the two would have to be Under Armour. They'd be the safest bet to invest in with your money, and the safest in their industry. This will conclude the presentation. I hope you all learned a little bit. Thank you.